Global Finance, Topic 14A, NPV and WACC for projects with similar business risk and capital structure as the parent firm. Copyright Lou Gaddis. In this topic, we'll look at the basics of calculating WACC and NPV. First of all, definition. We'll call NPV, or net present value, the discounted cash flow of a project, where the cash flows are discounted at some rate K. We'll call that K the cost of capital. And we'll usually call the cash flows free cash flows. And we'd also subtract any initial cash flow or outlay today. The general rule is you accept all NPV projects greater than 0, which means that the project returns exceed the cost of capital or the cost of financing the project. Free cash flows include both the initial investment and all future investments, or free cash flows. And those are cash flows that are available to distribute to security holders of the organization. So this is not accounting profits. These are actual cash flows that are generated. Now, there are two types of cash flows that are generally used in discounting. You can either have free cash flows to equity or free cash flows to the firm. Now, free cash flows to equity would be cash flows available to pay stockholders in the form of dividends. So these cash flows, free cash flows to equities, would already have interest subtracted out. Therefore, the remaining cash flows available to pay to stockholders last. Free cash flows to firm are cash flows which are both available to pay to stockholders and bondholders. So in this case, we're not going to subtract interest from free cash flows to the firm because these are cash flows available to both stock and bondholders. These cash flows are before interest and dividend payments, but do include taxes. We also want to add back any non-accounting costs or non-cash accounting costs that are subtracted in the normal calculation of net income. And those are things such as amortization and depreciation. We also want to subtract any capital expenditures, including any working capital. So a good working formula for free cash flows of the firm would be the earnings before interest and tax times 1 minus the corporate tax rate, adding back depreciation and or amortization, subtracting capital expenditures, which would be cash outlays for capital goods like machine or equipment, and subtracting any change in net working capital like inventory. The discount rate, or cost of capital, it should reflect both the claim on the free cash flow and the risk of the free cash flow. In other words, if the free cash flow is the free cash flow to the firm, the K is going to reflect both the risk of both debt and equity, so it should be the weighted average cost of capital. If the cash flows were just free cash flows to equity, is what you're measuring up here, you would only use the cost of equity. This discount rate, in theory, should capture the systemic risk of the project. In other words, the risk not diversified away when a shareholder owns a diversified portfolio of stocks. And again, the weighted average cost of capital is the most common way of calculating a cost of capital free cash flows to the firm. The weighted average cost of capital will be the cost of equity, in other words, what return is required by stockholders, times the percent equity in the firm, so the percentage of the firm that's financed with equity, times the cost of debt, which will be the required return that bondholders of the firm demand, times 1 minus the tax rate, because the interest payments on bonds are tax deductible, so the firm doesn't really recognize the full or experience the full cost or the interest payment because it does create a tax shield, times the percentage financed with debt. And we want to make sure we use both for E and D, equity and debt values. You want to use market values whenever possible. And you want to use the target debt to equity ratios for a new project. And just a note on D to E versus, say, E plus D over E. There's a little bit different. So this would be, say, a debt to equity ratio. Let me change that. Let's just make that E or D over E plus D. So let me just point out a little difference here that might show up in some problems. A debt-to-equity ratio is the ratio of debt of the firm over equity of the firm. That is not this. This is the percent of debt in the firm divide, so it would be the debt divided by total E plus debt. So if a DDE ratio is 0.6, what that implies is 0.6 of debt for every 1 of equity. So if a DDE is 0.6, the debt percentage that we use in the WACC formula would be 0.6 over 1.6. There's my 1. So that ratio would be the debt percent. So there's a difference between a DDE ratio and a debt percentage. To calculate cost of equity, we're going to use our friend CAPM, which is just going to be equal to the risk-free rate plus a beta times a market risk premium. Market risk premium is the expected return on the market minus the risk-free rate. We usually use long-term T-bills or treasury notes, say a 10-year treasury note for a risk-free rate. And we usually use, say, the expected return on the broad S&P 500 as a return on the market. Beta is usually calculated from taking a regression of a stock's excess returns versus the market. So here's an example. I did one with eBay. So here's a plot of the eBay returns versus the market. So say on this day right here, we have eBay was up 20% and the market was up, say, a couple percent. And on a day like this, looks like eBay was up 50% and the market was up 4%. If you plot all these historical points, the best fit line, the regression line, the best fit line that connects all those dots, the slope of that line is the beta of the stock. So in this case, eBay had a 2.03 beta. For calculating cost of debt, there are several different ways. The way I'm going to use is you're just going to say the cost of debt is equal to a risk-free rate, just like CAPM, plus some kind of spread. And that spread reflects the riskiness of the cash flows. So for example, you're working in a BBB rated industrial company, and you're trying to get a weighted average cost of capital for your company, and you need a cost of debt. You notice that and you're going to use a long-term cost of debt, so we're going to use the 10-year. So you notice the 10-year treasury yield is 3%. You also look up in Bloomberg that on average, 10-year BBB industrials have an average spread to treasury of 1.5. So if I take my risk-free rate plus my spread, I get to 4.5%. That is going to be my cost of debt. So here's a problem that should be largely reviewed. So you have Apple's looking to start a new project. The project will cost $500 million today. And the project is launching of the mini iPad. This is before the mini iPad was actually launched. I did this example a couple years ago. So the key to this is this project has the same risk as, on average, as Apple's existing projects. Also, it's going to use the same capital structure, the same debt and equity percentages as the existing firm. They suggest that the project's going to last for 3 years, and its EBIT each year will be $400 million, depreciation of 80, capex of 75, working capital of 50, corporate tax rate is 40%, and then some capital market information. Treasury yields are 3%. Cost of debt, the spread for debt for Apple is 2%. The beta of Apple's stock is 1.3, and the market risk premium is assumed to be 5%. And the new project will use 90-10 equity debt financing, just like the existing firm. So we're going to calculate the NPV of this project. To do that, we first need to get the WACC and the cash flows and calculate the NPV. To get the WACC, I'm going to need cost of equity using CAPM, risk-free rate, plus beta times market risk premium. In this case, the risk-free rate would be 3% plus 1.3 the beta times 5% the market risk premium. That'll give me a 9.5% cost of equity. My cost of debt is going to be the risk-free rate plus a spread. That spread is assumed to be 2% for Apple. So I'm going to do 3 plus 2, or 5% is my cost of debt. My weighted average cost of capital will be the percentage financed with equity times the cost of equity plus the percentage financed with debt times the after-tax cost of debt that'll give me a WACC of 8.85%. My free cash flows to the firm are going to be my earnings before interest and tax of $400 million. 1 minus the tax rate will give me my earnings after tax. And then I'm going to add back depreciation and subtract CapEx and working capital. That gives me $195 million per year. And then my NPV will just be the present value of those cash flows. I spend $500 million today, or Apple does. They receive $195 million in 1 year, discounted at the WACC. $195 million at the end of year 2, discounted at the WACC squared, plus $195 million discounted at WACC cubed. And I get a negative 0.5 million. I'm sorry, negative 5 million, which is A. So I would not proceed with this project. So that's an example of how to use WACC and NPV to calculate the NPV of the project. So hopefully we learned exactly what NPV is, how to calculate WACC, cost of equity, cost of debt, and NPV. The next topic will be calculating NPV for projects with different business risks and capital structure.